Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita and we're coming to you live from the Suzlon studio. Let me quickly take you through how markets are doing, and it's an IT day of trade, at least that's what it seems. Even though the Nifty is absolutely flat, much better than what we had anticipated. IT is perked up 3.7%. And to kind of quickly mark out LTM, which is the stock, or rather the company which came out with numbers over the weekend, you're seeing a decent move on that stock price as well, 2.5% higher. Let's go across. We're joined by Venu, Lambu, who's the CEO and Managing Director at LTM, joining us this afternoon to give us a sense as to how the numbers are. You've sounded quite confident, Mr. Lambu, about growth picking up, especially from Q2, and then improving it further in H2. What's driving that confidence, and is it largely based on deals that have already been won? And there's an ramp up likely? Are you seeing demand improve more broadly? Give us the sense.
Firstly, the aspect about being confident on the growth is coming from the fact that two of our largest industry segments in our business have demonstrated a very good sequential growth. Both financial services and tech businesses have grown more than 3% on a sequential basis. I had indicated about financial services bottoming out in Q4 of last year, and then that's exactly how we translated into. We're seeing a good demand in two of our largest segments, so that's one indication. And the second is even in the consumer part of the segments, we grew 18% year on year. If there was no issue with regard to the Middle East or the delayed ramp up in the India projects, we would have grown even sequentially on the consumer segment. So the aspect of our leading segments is back to sequential growth is contributing to that confidence. And the second thing is that in the consumer side of the business, we did announce a very large deal. It's part of the vendor consolidation for the large global multinational based out of US. So that's going to ramp up in beginning of Q3 as well. So combination of all these three things is where the confidence comes about growth in Q2 and beyond.
After Q1 earnings, are you on track to still achieve the guidance for FY27? Will the growth be stronger than FY26 growth?
Well, I think I did mention about the base at which we will enter into the FY27 was, is about 6% year-on-year growth that we had in FY26, and start working towards improving it. And that's exactly what we have done in Q1, right? On a constant currency basis, we grew 6.4% year-on-year. So we'll continue, getting better with that as we get into the Q2 and beyond. We don't give a specific guidance, but I did mention that the base is the same growth momentum as what we had in FY26 and get better on that. So I expect that to be better than FY26.
And North America, it's increased as a share of revenue this quarter. Are you seeing client spending recover faster in the US compared to Europe, and particularly around discretionary tech? How are budgets really shaping up? Could you give us a sense?
Look, the discretionary aspect of it, is common across both US and Europe. It is just that I do believe that, the whole discretionary spend is going to be redesigned from the clients. They're going to look at, a different level of priorities on the spending pattern. So the priority one is about all the discretionary spend that is oriented towards AI adoption, whether it's getting your data ready, modernizing your legacy, or even the talent transformation aspect of it, or building an agentic infrastructure, creating industry-specific SLM models that clients are focusing on using their data. So these are the aspects where there'll be prioritization of the spend. The second one would be, there are backlogs of the projects with some of the clients. They're looking for an environment with a better macroeconomic situation so that they can accelerate that. But at the moment, I see the priority is more towards the AI-centric or AI-related spend.
And AI revenue is now running at about $600 million odd and, on an annualized basis. Could you give us a sense on what that actually consists of in terms of a breakup, and how much is coming from AI-specific programs versus AI being embedded in broader deals?
The way we look at AI is basically the four types of AI work that we do. The enterprise AI, which is all about infusing AI into the core IT services. The second is the business AI, where AI, gets into the core business process in redesigning and reimagining the core business process so that you enable the competitiveness of the clients, either in terms of enhancing the revenue experience or the cost aspect of it. The third is the creative AI, which is essentially addressing the CMO agenda in both content and the creative side of the entire marketing stack. And the fourth is the industrial AI, which is about addressing the supply chain or the connected products and connected manufacturing agenda for the clients. So these are the four types of AI work that we do. When we classify AI revenue, we look at the three ones, which is the business AI, creative AI, and industrial AI, which is about 12% of our revenue now. And we are confident to increase that. I expect that part of the revenue to grow faster than the company growth average. And in any case, as part of the 5-year strategy, we have mentioned about having 50% of our total revenue to come from AI native services, essentially around the three types of work that I mentioned. And today, incidentally, we announced a big partnership with Anthropic, to accelerate the cloud adoption, both at the software engineering side as well as creating industry solutions and reimagining the business process for our business AI. So and the partnerships like the one which we announced today with Anthropic is just going to accelerate our AI revenue.
And on that partnership, how should we think about it relative to your existing AI ecosystem? Is this mainly about strengthening your tech stack? Do you expect it to meaningfully improve your ability to win transformation deals? How should one look at this particular partnership?
Well, the partnership has two aspects. The aspect of creating, the skills and the talent base within our ecosystem. It's about co-creating industry solutions, and most importantly, leveraging our Blueverse platform and the entire Blueverse ecosystem in collab and using all the fantastic models that Anthropic has in creating the right knowledge fabric for our customers, creating the right agentic solutions, and building more new services layers for our customers. So that's one aspect of the partnership. The second aspect of the partnership is actually going together, to the customers in accelerating the AI deployment for our customers. So we're training our salespeople. In fact, we've sort of launched a very aggressive AI training for our sales organization to essentially capitalize all the opportunity that lies ahead in terms of AI adoption, and that's what I'm excited about it. And this partnership is going to help us both in go-to-market agenda as well as in our competency and talent transformation agenda.
Okay, and margins continue to be fairly stable for you, 15 to 16% range. What will drive margin expansion from here? Is there still room to improve utilization from here, 86%? You think future margin expansion will depend more on AI deals, pricing, operating leverage? What will it be?
Well, it's a combination of all the topics that you mentioned. Firstly, if you recall, we launched Fit for Future program last year, and that program helped us to get better on overheads, get better on our utilization, and it started a culture of redefining the cost of delivery. And this year, we continued that acceleration of redefining the cost of delivery with a program called New Horizons, which is all about challenging ourselves and the status quo and redefining what should be the right cost of delivery for different category of services. And we put all that under a program called New Horizon. So the benefits of New Horizon program, part of that was visible as part of the Q1 margin expansion, and the same thing I expect as we go into the second quarter as well. So that's one aspect of it. And the second is, the AI revenue is actually coming at a higher gross margin than the traditional core services. So that will also contribute, to our confidence about expanding our margins in Q2 and continuing it for the second half of the year.
And could you give us an update on the Randstad digital acquisition? Any outlook on the timeline for closing, and by when do you expect revenue synergies and margin benefits to start becoming visible?
So we expect the Randstad transaction to close in the beginning of Q3, at the end of Q2 or at the start of Q3. All the regulatory approvals are going as planned and as scheduled, including the consultation process. So our estimate at this moment of time is that we'll start consolidating from Q3 onwards, and at that point of time we will give you a lot more visibility in terms of the overall margin and the revenue from the day one.
Okay. All right, Mr. Lambu, thank you so much for joining us and giving us that perspective. Well, that's the management of LTM with regard to its numbers, sounding strong, at least from a growth standpoint for the rest of the year. While this particular quarter wasn't the best in terms of growth, but the rest of the year looks strong, at least at the outset. What we'll do is slip into a very short break, come back, plenty to speak about. We'll try and get a perspective from Pramod Gubbi of Marcellus Investment Managers as to what he's doing in a market like this. Second, of course, we'll quickly also get a whiff of what's happening in markets, try and get a sense as to how the trades are playing out and what's happening in IT. We'll get a technical check from Kunal on some of those as well. On the other side of this break, stay with us.